Welcome everybody to the February 2024 mortgage and real estate market update with Jolene Moore. I'm Cindy Bishop with Cindy Bishop Worldwide, and welcome all of you. I'm so glad that I wish something like this was available when I was practicing real estate. Our speaker, Jolene Moore, is a top producing lender. Her elevated knowledge of market intricacies as well as her attention to detail will always cause her to be one of the best mortgage finance authorities in your market today. Jolene has an abundance of experience and a keen ability in the real estate lending field. She is not only a top producing lender nationwide, she is also a branch manager and senior home loan consultant with Cross Country Mortgage in Fairfax. Jolene is also a well-respected and sought-after trainer with us at Cindy Bishop Worldwide. Pay very close attention to all the things that are coming up with Jolene. It's not like her name is on our in our website portal under Cindy Bishop Worldwide upcoming events. But I did mention that the in-person mortgage 101 on the 21st is in Fairfax from 1 to 2. You can register under in-person events. And also on the 28th, one of my all-time favorites is her divorce class. It's at 1 p.m. on the 28th. Make sure you sign up for that. You'll find that under the webinar button. All right, Jolene, take it away.
Hi, thanks so much, everyone. Yeah, Robin, I saw your message. You'll turn on after eating. So thank you. I'm talking to emptiness out there. So like she said, if anyone can turn it on, that'd be awesome. But again, if you guys have any questions throughout, feel free to put it in the chat or unmute yourself so that we can communicate with each other. This market, as I'm sure you guys all experienced, has taken off last month, and multiple offers, contingencies, all that kind of stuff. So I'm just going to update you kind of like on where the interest rate market is, what I'm seeing on lending side, and then also some ideas for success in this market that we're currently in. All right, so the rates in December, we saw the market start to improve. In January, we did see rates start to move up. And a lot of that was the driving factor was in January, the job reports for December came out and they were higher than expected. So anytime the economy is perceived to be doing well, it's usually not good for long-term interest rates, so mortgage rates. Earlier this last Friday, the job reports for January came out and they were almost double the job creations of what was expected. So again, I think Friday ended up being the biggest one-day jump in rates in the past year. So we moved up a decent amount last Friday. So I'm telling you guys this because I think that this should be, scary, or that we should be concerned that's going to impact the market, or and slow it down, because I do think there's so much there's not enough inventory and obviously a lot of demand, because my leads and applications that I received in January are probably the most I had seen since January of 22, and applications probably go back to 21. So there's a lot of people coming out and really interested in purchasing, and I don't think rates are going to necessarily stop. Majority of them, obviously some of them it's going to impact, but it's going to impact their affordability as well as their purchasing power. But I'm also telling you this because I want you to know that if a client comes to you, and mentions, like, you see a rate, that you understand why it might be that way. It's not that particular lender. If it's me, it's not me. It is the market. So the market has moved up. We're seeing, we're going to see that. I think we're going to see some fluctuation and potentially volatility over the next few months as different economic reports come out. In general, I would say rates are probably still in the high sixes on conforming loan amounts, which are below 766. You might be in the sevens if you're above 766,000 loan amount. VA and FHA are still on the lower end. Those are still in the lower sixes without points. So, VA borrowers, I was comparing one that was looking at a VA versus conventional, And it was about a 0.5 point difference. So it definitely has been a big impact. So again, on the listing side, when you see VA contracts, keep that in mind. That's why they're, one of the biggest driving factors for VA is the interest rates are much lower than conventional loans right now. The Feds met last week. They came back and said, that Powell believes that they've hit their peak for the Fed fund rate. So that means they don't see themselves raising their rate anymore, which is good news. But what it does mean is they don't know when they're going to lower it, right? So Powell was actually interviewed on 60 Minutes over the weekend, and he's initially there was thoughts that they could be cutting their rate. I think it was like a 60% chance that they could cut their rate in their March meeting, based on the job reports that came out last week and how strong that was. They're not expecting to cut until potentially mid-year, but it's all going to be based on what the inflation numbers do. So if if the Feds feel confident that the inflation is trending down and it's going to hit their target of 2%, then we could see them start to lower their rate. And again, their rate doesn't directly correlate to what our interest rate is going to be, but it definitely gives the market, the bond market that controls the mortgage interest rates, the indication that the Feds feel like inflation is under control, because inflation is something that also causes our interest rates to increase. So as inflation is increasing, or if the economy is doing well, mortgage rates tend to move up as well. So this would be an indicator for the bond market when the Fed start to cut their rate, that inflation's under control. And then that's when we could see our rates start to improve even more than what we made prior to that. So keep those things in mind. So we'll see, I'd say, I think the expectation is potentially their June meeting is where we might see the Fed start to cut their rate. Then again, that could be a driving factor for us to see our rates improve further. Anyone have any questions on like the interest rate, the market, like what's happening, anything like that? All right, so market news, CoreLogic came out and basically indicated that they reported home prices rose 0.1% in December, 5.5 year over year. An interesting piece of information is CoreLogic came out at the beginning of the year, and I think they thought the appreciation might be around 3%, a little over 3%, and you can see that they obviously were off on that, and it ended up at 5.5. I think they're expecting this in 2024 for prices to appreciate. I think their expectation is like 3 or 5%, whereas Redfin said 6.4%. So we'll see, what ends up, but nonetheless, overall, I believe everyone believes in 2024, as you guys have already seen, we're seeing escalation clauses and, many homes going over list price, that we're going to see appreciation in our market again. So the average sales price in 23 for us was down about 1.7%. The units sold, basically across the board, we're down. And I know we all felt it. Not everyone, there were definitely agents that I've talked to who had, a great year, some the best year they've ever had. Some had stayed right on par where they've been. So, obviously it depended on your clientele and your marketing and all that kind of stuff. But I do think the next 2 years are going to be very strong. So we got to be, have our head in the game and make sure that we're doing everything we can to stay in front of our sphere. Now, one thing that was in December that was interesting is the cash deals was 26%. That was the highest percentage I've seen. So, it's almost 1 in 3 transactions. In the years past, like beginning of the year, I think it was 21, 22. I think last year was like 19%. So we've obviously seen that increase. Some of that is, I think there's a statistic that average loan to value in the country, I think it's like people have like 48% equity or something like that. Like it's really significant how much equity everyone has. So I know I have clients reaching out to me trying to tap into their equity of their current home to be able to buy a new home. If they sell their current home, they're going to have obviously a lot of equity potentially to put down or pay cash for the new home. And then obviously people are making money in the stock market. Stock market did well as well last year. So there's lots of things happening, but that's kind of like an overview of what the market was kind of doing in our area last year. Anyone have any thoughts or see anything? You know, I look up like the Dulles Area Association and the Prince William, and they just don't give the data as well as the Northern Virginia Association. So it's hard for me to get like year-to-date information. It's only by month. But anyone else, see anything different in their, if they have direct correlation to any of the other associations that I haven't mentioned? Okay, this is kind of, you know, like a chart that I've been sharing. So you can see Black Knight, year over year, we increased by 5.6, 5.6. CoreLogic was 5.5. And then, you know, FHFA, which is Fannie and Freddie, you know, says it was increased over 6.6 year over year. So again, the experts believe that we're going to see probably similar numbers, I would say, in 2024. All right, so, you know, one of the biggest questions I get, because I'd say the majority of the clients I'm talking to right now are first-time home buyers. So I'd love to hear from you guys if you're seeing the same thing. So for first-time home buyers, you know, the question is always, do you have any grants? Like, do you have any, you know, what programs are available for first-time home buyers? So there is a grant that just became available again, and it's all about when the funds are available, and it's the FHLB Atlanta grant. And this is $12,500 for first-time home buyers. It is income-based. You know, you have to be a first-time home buyer. There's other restrictions associated with it, so it's not going to fit for everyone. And then there's also potentially $15,000 for community partners. That would be law enforcement, educators, healthcare, first responders, military. There is also a recoup period here, like you have to be in the home for 5 years as your primary residence without having to pay it back. So there's, but the funds, I talked to the one of the women that's at this organization, because it's a lot of lenders that are tapping into this program. She said last year the funds went in 3 weeks. So unfortunately, they go very fast. And so, you know, if they're available, it's something that we have access to, you know, to be able to provide to clients. And we'll walk them through if they fit the parameters for it and the guidelines. This is household income based instead of just the income we're using for qualifying. So even if like we have just one spouse on the loan, but the other spouse is not on the loan, but living there, we still have to count that income. So like I said, there's some little nuances that we have to walk through to make sure if the client's going to qualify. Cross Country has a grant as well. That's up to $4,000. And also based on certain neighborhoods like Baltimore, I just did this one for a client in Baltimore, it was $6,500, because based on certain communities, you know, when they're trying to bring new people into that community, we have other type of grants that would be available. So we'll, you know, again, these are income-based, they're for first-time home buyers, you know, all that kind of stuff. So unfortunately, it's good and bad. There's a lot of first-time home buyers in our market that make a decent amount of money, right? And they make more than 120,000 or 150,000 or 180,000. So it can be disappointing to them if they don't fit into these boxes to get this, you know, these grants. But unfortunately, those are the, you know, the parameters that all of us have, and that we have to find and fit within. There's also a first-time home buyer benefit for interest rates. If you make less than $180,000 and you haven't owned a home in the past 3 years, there's going to be lower interest rates than if you were not a first-time home buyer. So there's a lot of different factors that we look at. And that's why we get their application when we do a pre-approval, because we have to look at their income, we have to look at their credit, we have to look at, you know, who's on the loan, what's the household look like, all those kinds of things, to be able to really tell them exactly what they can qualify for and what programs are potentially going to be able to be used. Cross Country has a Buy by MI program. I've mentioned this before, but just so you guys know, there's if you see it, you'll know that it truly is real, that we're 15% down, no mortgage insurance, and the rate is essentially the same as the market rate. So there's no bump up to the rate because we're not charging mortgage insurance. We also have a buy now, save later right now that basically we're going to waive our lender fees when someone refinances with us once we've done their purchase. So it helps because, you know, obviously with what we were just talking about with rates being where they are, you know, I was just on another call earlier and it was talking about, you know, it's not about timing the market, it's about the time in the market. So we want to help clients get into the market and start, you know, earning the appreciation we were just discussing, being able to, you know, not have to compete even further as the rates improve and we have even more buyers coming into the market. So once the rates do improve after they buy now, we have the ability to waive our lender fees. There's still refinance costs, and any lender that says there's no refinance costs, they're truly bumping up the rate to cover that. Because all we have control over is our lender fees. Everything else, you know, there's state and county taxes, title fees, all of that kind of stuff. It still exists, right? So there's got to be a way to cover it one way or the other. But we are covering our fees for refinancing in the future. You know, lots of new program, or not new, but programs that I've been discussing. And I just, again, I meet with agents individually, and sometimes they don't always know about this. So I just want to make sure that everyone knows the different types of products that we have. You know, we have, you know, the traditional, you know, that we always talk about, conventional FHA, VA, you know, renovation loans. We have construction loans. We have the DSCR loans. So like I have a client right now who wants to do a cash out refinance on an existing investment property she has. She's not going to qualify for her debt to income ratios regularly. So I'm looking at doing a DSCR loan, which means we're going to just qualify her based on the rent that she's collecting on the property versus the mortgage. And as long as that rent exceeds the mortgage payment or meets it, then we can do the loan without having to use her tax returns and all of that. So there's a bank statement program for self-employed borrowers. The buy now, save later that's for clients that are looking to buy now, but not sell their house till later, but maybe they don't qualify carrying the current house. So if we have a listing agreement that says they're going to be putting that house in the market within the next 90 days, we don't have to count that payment against them for qualifying for the new house. And then there's asset qualifier where you're using their assets to qualify to purchase the home rather than, you know, actual, you know, being employed, having pay stubs, things like that. Now, the thing with all those loans, anything that's outside the box, and this is going to be no matter what lender you're talking to, it's going to be a higher rate, right? So they're paying for uniqueness, right? They're paying for portfolio. So they have to know going in that this is going to be a higher interest rate. Again, it's something to get them into the home and, you know, have a long-term plan of what can we do to get them out of that loan, you know, based on tax returns or things like that we can help set them up and prepare to be able to refinance down the road. So it's just something to think, you know, keep in mind, because if it's in a situation where they really want to purchase now, but they're not in a position, you know, in income wise or whatever it might be, that we may be able to still get them into the home and then work with them, you know, to be able to get out of that particular loan down the road. Some questions I've gotten recently, and so I thought I'd share this, and, you know, we'll send you guys this, slide. But if you ever either have a listing or you have a client that you're making an offer on and they're using an FHA or a VA loan, and you're wondering if that community is FHA or VA approved, these are the websites that you can go to put in the address or the name of the community. And what I would always suggest is putting in just the first word of the community, because a lot of times, like I had one that was, it looked like it should be one word, but it was actually in the VA portal as 2 words. So initially we didn't see it, and then we, you know, redid it, and then we saw it. So there's, you know, sometimes you have to mess around and just don't assume because you put that whole word in that it's not approved or it's not in there. You know, mess with just putting the first 3 letters of the word, or, you know, just the first part of the word and leaving off the other part. And obviously you can always reach out to me. I'm happy to help you guys, but I know if you're in a crunch and you want to know, this would be a good way for you to be able to get to it quickly. But, you know, I'm always happy to help you guys know what that looks like. Thing to keep in mind with FHA, it's approved, but it has an expiration date. So the community always has to apply when the expiration hits. And that's what it will say in the FHA portal, whether or not it's approved and when it expires. So keep that in mind. Like if you're making an offer and if it's going to, you have to close at least before the expiration date. So if the expiration date is on the day we're closing, it's okay, as long as it's approved as of the time that we're closing. And so then, you know, I'll tell you, you know, Robin's on here, and this is actually a conversation her and I were having. But one of the things that came up for us last year was about doing a spot approval for an FHA loan. So we thought the community was approved, and it turned out it wasn't, because we had we had gotten the wrong name on the contract. So we did a spot approval. So as long as the concentrate, they don't want more than, I want to say 15%, but I could be wrong, and I can double check this, but there's a certain concentration. They don't want more than a certain amount of FHA loans in that community. Because basically if that community was to go, downhill, basically that would be a lot of FHA loans that could go into default and put the program more at risk. So they don't want they only want a certain amount of FHA loans in the community. So as long as you don't exceed that FHA concentration amount, you can do what's called a spot approval for FHA. So it's an application we fill out, we send into FHA, and we get it approved. We did this last year, like I said, and I think we got it approved within less than a week. So it was very quick turnaround, fortunately. Obviously, FHA is not as busy because, when you look at the percentage of transactions done in our market of FHA, it's only 3%. So it's a small number, right? And so there's a reason for that, but just something to keep in mind, because there are situations where the client needs to go FHA. So I just want to make sure you're aware of that. The good news with VA is that approved condo is approved. As long as it's approved, it never expires. So as long as it says approved without conditions, then you're good to go on VA. You never have to worry about it expiring. Anyone have any questions on any of these bullets, any programs, anything like that? All right, you guys are very quiet today. So Sherry says you can recommend by looking by zip code too. So you can use the name of the community for the condos or look it up by zip code, and it'll give you the name of the communities in that area. So thank you, Sherry. All right.
Jolene,
Yeah.
is any limit of time to refinance and have no mortgage fees or lender fees?
For my program?
Yes.
I think it's 18 months is what we're doing right now.
All right. Thank you so much.
Yeah. But they've been doing it and they've been extending it for many months, so it could continue on. Our company continues, just because of where rates are, they've continued to extend the program. So it could end up being longer.
And how's the activity on buy downs?
I'm sorry?
How about buy downs?
Like buy down for interest rates?
Yes.
Do you mean like the temporary buy down, or like paying points where you're permanently?
No, like limited time, like 24, 36, I don't know, 48. That was normally the terms.
Yeah, there's a 2-1 buy down, a 3-1 buy down, a 1-year buy down. So there are temporary buy downs available. We have, obviously, depending on the product and the program, oh my gosh, the property, right now it's hard overall to get seller concession, but if you have a property where you have negotiating power and we can get money from the seller to do the buy down, we do have that ability to do, 1 year, 2 year, or 3 year buy downs.
And that refinance will apply to those two?
Yeah.
Okay, thank you.
Yep. All right, thank you for those questions, Gilma. Anyone else have any questions? All right, awesome. Okay, so ways to be successful in this market, so tips for success. So fast closes, that has been, I know, everyone hears it, but it's definitely been a huge driving factor for a lot of my clients to allow them to be successful. Obviously I know there's a lot more involved. There's the contingencies, what they're actual, with the offering, what they're escalating to, things like that. So but that's one of the things, and most of the agents I work with do such a great job about this, but you really want to make sure your client gets pre-approved in advance of seeing homes, because it's just too often where a client goes out and they think, oh, I'm going to wait for a few months to buy, but I want to just kind of start looking, see what's out there. And then they see the house that they love and they want to make an offer. And now they're kind of behind the game because they haven't gotten pre-approved. They haven't provided any documents. Can they close quickly? Can they waive contingencies? What do they have? Do they have the ability to waive the appraisal? All those things are so important in this market that you want to make sure that your client is pre-approved well in advance of seeing homes, so they have the strategy and they know what their capabilities are, you know, before going out. The other thing is providing the documentation at pre-approval. There's a lot of lenders out there that do not ask for documentation at the time of pre-approval. And so your client might be like, oh, I'm pre-approved and I got, you know, pre-approved within an hour. More than likely, they didn't provide the documents, which means, again, you're not setting yourself up for success relative to fast closings. Because the more documents that I gather at the time of the application, you know, the pre-approval application, the better I'm going to have the ability to say, okay, I can close this in 8 days or 10 days or 11 days or 12, whatever it might be that you guys need to make that contract successful. So again, you want to make sure they're working with a lender like myself that is asking for that information, so it helps prepare them for success, you know, and that's the reason why we do that. So, and if they're working with someone that's not, then, you know, it's just risky, and it's gonna, you know, slow down the process. The other thing that's come up recently, I've had a couple clients, and I have one right now that we're in the process of, you know, VA changed their guidelines last year. There's a few things that, and I just want to make sure everyone knows, is one, if there's any repairs that are needed on a VA appraisal, VA does allow the buyer to make those repairs. Obviously, it's prior to closing, so but they allow them to pay for it. It doesn't have to be the seller. So I have one right now where they went in, you know, they didn't have the mandatory clause signed at the time of the contract. They waived it, everything. And so now the buyer is the one they knew going in that they were going to have to be the one that made the repairs if anything came back. Now, the other thing that's come and that I discovered last year, and I've been in this business 20 some years, is you can request from VA to waive the repairs. So last year we got a handrail waived. We got a ripped screen on a window waived as well. So this particular transaction I have right now, there was a list of repairs that's needed. The appraiser actually even said to us herself was, I would recommend reaching out to VA to see if you can get any of these waived, because it was a decent sized list that she was requesting, which it's a home that needs help. So we knew that going in. And so we are sending that to the VA, and we're going to ask them to waive, and we'll see what we can get waived so that the buyer doesn't have to make some of those repairs prior to closing. So I have a great contact to the VA regional office that's helped us be able to figure all that out. The other thing I'll tell you guys, if you don't know this, you know, it doesn't come up too often, but VA also used to require a road maintenance agreement if there was a private road in near the property, you know, on the property, or, you know, that the property had to use. They now do not require private road and maintenance agreement. It just needs to be recorded with the county, with the title as an easement. So some things that could help us, again, so that we don't slow down the process. The other thing, you know, we're going to be coming into is appraisal gap strategies, right? So if you're making an offer for a client that, you know, they're offering 700 and you think it's only going to appraise for 675, what does that mean for the client? Are they going to have to come up with more money? Or is there ways that we can strategize so they don't have to bring any more money, and we just shift things basically how we're allocating the funds? So I have one right now where the VA appraisal did come in low, that one we were just talking about. But because they're putting so much down on this property, they're actually not going to have to bring any more money to closing. We're just going to allocate the funds, you know, some towards making up the gap between the sales price and the appraisal, the rest towards the down payment. But then our sales price comes down, right? Because we're now basing it on the lower of the appraised value. So it all works out where the buyer's not bringing any more, and it doesn't change their monthly payment. Now, it's not always like that, but that's why we want to have those strategies. So if you're working with us, what we always want you to let us know is, we're going to be making this offer on this home. The house is going to be, you know, we're offering 400, but we think it's only going to appraise for, you know, 390. What can we do? Like, how do we help that client understand what their possibilities are for that and what the ramifications can be? And, you know, there are times where it may not have any really much impact at all. So that's what we're here for, to help, you know, make those, have those conversations so that we can help everyone, you know, be set up for success when they're making the offer. The other question is float downs. You know, we had a time where the rates were improving. So what this means is, like, let's say you've locked, the client is under contract, they've locked in their interest rate. And this is going to be with any lender, where it's me or another lender. you now want, the market is improved, right? And you want to be able to float the rate down to take advantage of the market improvement. I just want you guys to understand that that float down is never going to be able to get to where the market is. Because when a lender locks in that rate, they're securing that rate with the bond, with the market, right? They're securitizing that with the secondary market is what it's called. So the back end of our business. And basically they're securing that, saying we're going to be providing this loan at this rate. And so we've locked in this, we've secured this rate. So there's a cost to all lenders when they're doing that. And so then when the market improves, they have to take into account that cost that they've had by securing that rate. So then there's a cost to float the rate down. So for us, it's a 1 percentage point, 1% of the loan amount that it costs. So it means that the market has to have improved 100 basis points. And it's hard to understand that, you know, without being in my industry. But what I just want everyone to understand is it's not as simple as saying, oh, the market has improved, you know, they want that, what that rate is. That's not how it works. You know, most of the time, if the market improves like a half to, you know, maybe 0.5% or greater, they may improve the rate in 1/8, maybe 1/4%. Because especially in our current market, the way interest rates are priced, there's not a lot of gap between each rate. So it's hard to get that major improvement that they're looking for to be able to float down. So again, I'm not expecting you guys to understand that completely, and it's hard to explain it totally, but what I'm wanting you just to know that that's how it works with the float down, that they're not going to ever get to the market, what the market is, without paying. They can pay to do that, right? They can pay points to get the rate back down to where the market is, but for free, that's not going to happen. So any questions you guys have on any of these, you know, situations here? And does the float down make sense? Do you guys understand that? Does that make sense? Either for further clarification on that? All right, thank you, Nicole. All right, anyone else? Any questions? Anyone? So is everyone pretty much seeing, because I'm sure you guys are in different different parts of our market. Are most seeing multiple offers, you know, with escalation on the majority of properties? I know it's not always on every property, but are you competing on almost most offers you guys are submitting right now? And is there anything that you've done to, you know, that's kind of helped separate your buyers? You guys, come on. Thank you, Robin and Nicole. I appreciate it. Anyone else have anything, any like tips anyone else has that's happening in this market right now? On the listing side? You know, and I talked about this last week, just make sure you guys are doing open houses when you do have listings, even though the market's moving quickly, you know, it's a great opportunity for you guys to get more business, you know, because it's really about trying to create market share right now, and get as many, you know, many people that you're talking to, because it's going to take more to probably do the same amount of leads because of the competition we're seeing. I mean, same amount of transactions. So, you know, we just want to keep having those conversations with everyone. So Sandra says, are you seeing any contracts where sellers offering 0 buyer agency commission? If so, how has the commission been compensated outside the buyer paying it? And what about buyer agent commissions for BA buyers? Has anyone seen that? I heard recently an agent of mine said that one listing was offering 1% on the for the buyer. Has anyone else seen where they've been offering 0? And Cecilia, you said most are scared about the monthly payment. And Cecilia, there's conversation, you know, obviously the monthly payment can be, you know, scary, but it's also ways to kind of talk them through that. You know, obviously they have to be able to afford it, and you don't want them going in where they're going to be, you know, house poor, but also knowing it's not always forever as well can help, you know, some buyers, because there's more buyers I feel like I'm talking to right now that understand the you know, see the big picture of like, if we get in right now, It's not forever what we're going to be paying. So it can allow us to get in without potentially competing as much as they will, when the rates improve further. So no one has seen 0% commission on any listings? Nope, nope. All right, good. Well, let's hope that stays that way. All right, Sandra, have you?
Yes, I've seen it in the list in the MLS. Yes, I have seen it,
You
but
have
I
it?
haven't, not that I've had a personal experience with it, but somebody
Okay.
highlighted a listing that had 0% from my brokerage.
Yeah,
So it's out there.
okay, okay. Yeah, I mean, obviously, the only thing you can do is, I mean, not only thing, but, like you mentioned, the buyer paying it or negotiating it as part of the transaction, which is obviously that could potentially down the road be a negotiating factor. Cause I know in the height, like in COVID, there were people that were offering to pay the seller's closing costs. So that, obviously could be part of it when you're paying the commission, as well. So different, strategies that might be coming out.
There's a pretty big brokerage in Maryland that just sent out a lot of oversized, they're bigger than 8.5 by 11 flyers, like with Every Door Direct, offering listings at 2.75%. So I don't know what they intend to co-op, and I haven't remembered since I got that in my mailbox. I haven't gone to look to see what they're co-oping, but that would be interesting.
Wow.
The total listing.
So a total commission of 2.75.
That's what they're saying. So I don't know whether the gossip that I hear is that they've been recruiting very heavily, and that they have a pretty big monthly rent where in the building they took over. So I don't know, but I'll email if I see that, but I didn't look. But the 2.75, just like, and Redfin is offering that if buyers sign a buyer agency agreement, they'll rebate the money.
Yeah, I saw that they came back out with that. They used to do that and then they stopped it.
They
So I
used
think
to
it's 0.5% now.
And if you're over $1 million, they give you more. I think it's 0.25% to a certain level, maybe 500. I don't know. Over $1 million, I think you get 0.5%. I don't know. So
Yeah.
kind of crazy.
Well,
And
it's everyone's going to create different
Dinner.
strategies of trying to gain, the transaction. So we'll see as we go along. But that's also what you guys, obviously we don't want to. There's ways to strategize marketing and things like that to create without having to do some of that. But all right, well, I think that's it. This is all my information. Again, if there's anything we can ever do to help you guys, please reach out. This is all of our contact info. And if you could also follow us on Instagram, if you already aren't, Jolene Moore Team, that would be awesome. We put out a lot of content that can help clients. Feel free to share it, copy it, whatever you need to do. All right, so thank you guys and have a great rest of the day. Bye.
Thank you.
And thanks for those who asked questions.
Thank you.
All right, bye.